Welcome to What's Brewing with IAT Insurance Group, where episode after episode we cover the latest marketplace trends with subject matter experts who are fueling our mission to provide insurance answers together. Grab your cup and let's settle in.
Hi, I'm Ben Mcdonald, and welcome to What's Brewing. I serve as Vice President of Underwriting at IAT, specifically the IAT E&S Contract Binding Division, and I am joined by my colleague, Claire Rinker, today, who is a Senior Underwriter in our Contract Binding Division.
Hey, Ben, how's it going?
I'm doing good. We have a couple of topics we want to kind of talk through, some things that are relevant to the contract binding space. One big one is what's going on in the industry out there. So we have a lot of industry trends, different things going on in the market, which makes it fun and why we are in the excess and surplus lines market. So we'll go ahead and get started with that.
Yeah, so Ben, you kind of teed yourself up, but what would you say are some of the heavy hitting industry trends that are happening right now that we are very aware of?
There's been a lot of change in the marketplace over the past several years. So in terms of the E&S space and more the P&C liability that we kind of specialize in, you're seeing a lot of fluctuation in the market. Over the past several years, you've had inflation that has taken a big hit to the market, so that affects liability and especially property, whether it's construction prices, cost of goods, repairs, labor. So you have a lot of factors that have contributed to what's really been over the past several years, I'd say, a hard market in many aspects. So you continue to see some of that. That's happened, some carryover, but you're seeing some pockets in the economy that maybe where you're seeing things peak. Property, for one, cat property has been a really tough one over the past couple of years. We're starting to see in some areas, like California, it has not reached its peak, and you continue to see issues, especially with the recent fires. So that's a continued trouble spot in terms of just limited capacity, companies making changes. And then on the hurricane side, while it was a more active year last year, you really didn't have at least a major impact to a major metropolitan area. So, and then the market has adjusted over the past couple of years, going back from 2020, 2021. So you're seeing some signs of the market moderating there, some changes happening around, every carrier's appetite when it comes to hurricane exposed property. So I'd say, if anything, it's a really mixed bag that's going on out there. But those are a lot of the just market trends that we see on our side. And then in terms of just the state of the market, the state of the insurance industry as a whole, you continue to have more and more companies moving to new technology, whether it be predictive models. We're all doing our best to try to get the most accurate information that we can about a risk and get it as fast as possible. So that both helps us make better decisions on the underwriting side. It can also help make our agent partners give them more information, so that way they know maybe what is the best market, where to go with it, and try to get them at least the most competitive pricing up front. So those continue to see a lot of change in that area of the marketplace. What I would say, and what I'm curious is too, that's what I see on my side, but what do you see in terms of trends in the marketplace on the underwriting desk? What things have you noticed recently?
Yeah, on the desk level, there's been a lot of really interesting pockets as far as regulatory changes and sort of legal environments and statutes that we have to be worried about. So, one of them could be a state's stance on an assault and battery sublimit, for instance, and if that state is going to accept a sublimit or if full policy limits are going to be available, if the defense is going to be acceptable within the sublimits, for instance. There's, I think, an increased demand for hired and non-owned auto coverage in a lot of policies, especially things that are coming out of standard markets where maybe they've had these, more robust policies or more inclusive policies. So trying to bridge those gaps as accounts move out of standard lines into our non-admitted space, and how we can fill those voids and really be a good match and good fit for insureds.
No, definitely. Yeah, that's a very good point with the changes in legal environment. And it's an ever-changing kind of landscape out there, and each state takes their own approach. We have seen that in a couple cases where courts make different rulings than maybe what we would have expected or what our policy intent was. So then we have to adjust. I'd say it's nice that we are on the non-admitted side. Being ENS, we're able to more quickly adapt to those changes as states make different rulings. We can more easily adjust our forms, adjust our pricing, adjust our terms, so that way we can try to, still do our best to be able to find a way to underwrite effectively and underwrite to a profit. But that, as you said, there's a lot of business that is being you know, coming in from the standard lines because in many cases they've been facing loss pressures that they're not able to adapt to quickly. So unfortunately for them, their only choice in many cases is to exit a class of business until they can either get something approved by a state. So yes, that's definitely been a continued trend, over the past year and even moving into 2025 is you still have various pockets of standard markets getting off a lot of risks. So then that creates opportunity and challenges for us on the ENS side as we try to, like you said, fill that kind of void for the market.
One of the things you mentioned too, Ben, was the predictive analytics and trying to make more informed decisions. I would just, maybe highlight our new risk analysis tool that we have implemented that is helping us more accurately price risks, right? So something that's going to be a preferred risk based on various characteristics is going to receive a credit automatically. We want to incentivize folks to place those kinds of preferred accounts with us because we know historically they're going to perform better for the book. So
exactly. It's something we recently implemented. We believe, analytics and getting the most accurate information possible is going to help our long-term profitability, will help our agents make better decisions for us, and help us internally review things better. So yes, our new risk tiering approach that hopefully our agents that do business with us have seen in our system. There's a risk analysis tab that is on there now that is pulling some additional information, and we designed it to try to make it as easy to use as possible, where we're not asking the agent to fill in a bunch of information to slow down their process. If anything, we reduce the amount of inputs that they have to enter in. So it's pulling things like credit score, crime scores, several factors that our analytics team has looked into. And as they've reviewed our losses over the years, they've seen some trends in that loss history. So it's really designed, as you said, to try to get a better pricing up front. What are the risks that we think have better risk characteristics? We're trying to give our better pricing up front on those risks, realizing we think we're going to have a better loss ratio on that type of business. And then some of the risks that have been more loss prone in the past that have driven losses, we're going to need to apply some debits. But the idea is we think in many cases we're still able to write those risks even though they may have a higher loss ratio with then the right pricing. So that's definitely the intent for the agents. I hope they find value in that. There's always change in anytime you introduce something new, but so far we're getting some decent feedback on it, and we're hoping that's going to be something for the future that will continue to let us be a long-term partner for our agents and continue to write business at a profitable level.
Yeah, absolutely. That's the goal. Profitability long term.
Yes. And one area question I have for you. So you underwrite, you have a pretty wide-ranging territory, but one of your territories that you underwrite a lot in is out in the West Coast. So there's a lot of different types of catastrophe threats that we see out there. How do you go about looking at the wildfire exposure that you do see more particularly out west?
Everything is kind of reviewed on an account by account basis. We've got our sort of team appetite, no more than a 55 wild score. So that's a flat rule. But for anything that's below that score that we're considering, the team is pulling street views. We're on Google Maps. We're walking around the neighborhoods to see if the building is in a valley, if it's up against a foothill, up against a preserve. thinking about burn history and how likely a fire is to spread. So we're really doing a lot of like hands-on, deep underwriting of each individual account that's crossing our desk and trying to make really informed decisions. And I mean, we call it basically an eye test. Like, does this look like it's going to be okay? And, we're just making the best decision that we can based on the information available. Luckily, we're getting more information now more than ever, but we still have a lot of opportunity to learn more about how things are being modeled, the predictions, different risk characteristics that we can make more informed decisions with. And that's very different, right, than what's happening on the East Coast and especially in the Gulf with hurricanes. So I don't know, Ben, if you want to talk about how we're approaching hurricane underwriting a little bit.
Definitely. For IAT, we do use different reports that give us some insight into that. As Claire mentioned, for wildfire, we use Risk Meter, and they give us a wildfire score. So every account in those more heavy wildfire-prone states get that score. And then similar for your more tornado hail zones or your hurricane zones, we're pulling different reports. So we pull a distance to the coast. That gives us, we're basing our wind hail rules on that and what areas we can offer wind coverage and where we can't. So that plays a big part in it. We also run modeling specifically for tornado hail and hurricanes. So that plays a part into it. And the model really does take into account construction type, occupancy types, year built. So it takes a lot of information that, at the end of the day is all designed to help us get to what we think is going to be an effective price so that way we can write something long term. That is the ultimate goal, is that we're not constantly jumping in and jumping out of certain markets, but that we're able to write something at a price that we think is going to allow us to write it profitably for a long period of time. So the reports definitely help us with that. Jumping back to wildfire, when we really got into the market, at least trying to write more property out west, our goal was always not to be a heavy wildfire market in terms of your really heavy risks. So that's why, the appetite you mentioned really is more of a lower wildfire score once you get, 55 or under, but really the vast majority of our book is under that 40 mark. So that's been a conscious decision by us to make sure that we're not, overexposing at least our property to where we're at, to try to avoid those bad days. And, the recent fires that happened out in California to start this year showed us that really, the majority, I believe over half the buildings that burned in those fires were more moderate to low wildfire scores. Knock on wood, we did not have a major event for us. We've, I believe, done a very good job in terms of maintaining our discipline and spreading our risk out. But there was a lot of risks that, how far in the city that fires burned, it was affecting many risks that were in that moderate kind of zone. So as you mentioned, our just additional check of looking at what is the construction type, what does it look like, clear spaces, that's what we use on those more risks that fit our appetite, but there may be more on the higher end of our appetite.
Yeah, absolutely. I mean, and like you mentioned, the whole goal is long-term stable presence in a market. I think that's really what separates the binding team here at IAT from some of our competitors. Is we're not looking to jump in and out of different segments, different classes. We'd rather make a smart choice, underwrite thoughtfully, be solution oriented for our insureds and our agent partners, but ultimately be a stable, reliable partner at the end of the day.
Exactly. That's where, I've been with IAT, the more binding specific, at least for going on over 13 years now, and that is definitely the goal. We want to be at least a stable market where you can come, put a decent risk for, and be able to write that risk for many years. And the tools that we put into place, some of these reports, how we look at heavier exposures like catastrophe, that's the attitude that we take towards it. So as we look at to continue to further expand some of our writings, and we've really focused on the past couple of years are really to make sure we keep diversifying our books so that way we are that long-term market. And as the market, as we let off the call, at least with the changing marketplace and kind of whether it's hard market dynamics, you have a lot of pressure in a lot of different areas. We think by us taking that more balanced approach, we've been able to be, with some adjustments, but overall still be a pretty stable market in those key areas and still be able to offer, wind coverage, whether it's in some of these hurricane zones or offer, property coverage in states like California that are going through issues with wildfire. One question for you. You just kind of touched on it, but what else would you say is something that, as an underwriter at IAT, what value do you think we provide, and what makes us stand out to our agency partners?
I mean, I think the answer is a little bit in the question. I think it is the underwriting team. We've got super experienced underwriters on the team, a depth of knowledge, folks that are really interested in solving a problem, being a solution, um, learning something new about maybe, let's say, a product that we're not familiar with, but being able to underwrite it thoughtfully so that we're approaching it in a way that it meets an insured's needs. For instance, we talked about our stable appetite. I think that's a huge asset that we have, that an agent of ours can say, I know I can have this with IAT for several years. So I think that's a huge advantage for us. And also, we have the luxury of choosing who we do business with, right? We're not appointed with every large shop across the country. So I think there is a level of exclusivity to doing business with us that I think can be really advantageous for the kinds of things that we can do.
Definitely. I definitely concur with that. I've heard that feedback from various agents that, they do like that we're not every wholesaler that they compete against has access to us. We've done our best to try to really look at our partnerships and be strategic with it, really partner with agents that we, feel have that same underwriting philosophy and are going to be long-term partners. And, I think we've been able to do that. We've been able to better spread our risk around the country, where we used to be more heavily concentrated in just a couple spots, where now we have relationships in the vast majority of the country, and we look to continue to build on those partnerships. So that's definitely something we value. We always value the relationship. At the end of the day, insurance is insurance, and especially the contract binding space. A lot of our competitors do similar things to what we do, a little different, but we definitely believe that that relationship is always going to matter. So
I know we're kind of close to wrapping up right now, but I wanted to hit you with a couple just like quick buzz questions.
sure.
Maybe we have someone who's listening that thinks of us as a property market. What else do you think they would be surprised to know that we can do?
Very good question. I think in general, our agents, what I would tell an agent who thinks that we are a property market, about 5 years ago, we used to be thought of as only a GL market and not a property market. So a lot of it is I'd want agents to know we can do it all. We have the ability to write liability, property, and liquor coverage as well when it makes sense. And, I think we have a very diverse appetite. We have a very experienced underwriting team that has both more, brokerage backgrounds, some MGA backgrounds, so they understand in many cases what our partners experience on their desk. So, I would say that really we can do far more than just the property. Of course, we prefer to write a package account, but we have that experience. We can consider your restaurants, some of your light products, a lot on the contracting side. Contractors is something that we're putting a lot of effort into right now. We've been looking at our rates across the board. We've taken some actions, and it's already in our system to be more competitive on classes that we think fit, your more typical contract binding artisan contractor. So, yes, I would say for anyone that, no matter what they know us for in particular, I would hope they know that we can do it all, and we definitely want to try to partner with them the best we can. So definitely reach out to your assigned IAT underwriter and get more information.
Excellent. I think a lot of our partners think of us as a HAB market. What else? If we're talking about GL, what specifically would you love to advertise? Or maybe our agents would be surprised to know that we're doing.
Yeah, so on the more GL side and habitational, while we definitely consider HAB, we still write a good amount of it. It's roughly, it's less than a quarter of our book overall, which is right around where I would say, want it to be. We want to be able to write a decent amount of habitational, not all, just like any type of class of business, not everything's created equal. So that's why we think things like the risk tiering that we've put in is going to help us better identify some of the really good business in that space. But that goes to your other classes. So whether that is some of your more restaurant type of risks that you may see, could be a caterer, could be some more service type accounts. So we see a good amount of those, from your janitors to maybe your regular kind of more machinery kind of repair kind of person. So we see the gamut from your small 1 to 2 person operations, some larger operations. Most what we consider is probably going to be under 3 to 5 million in total sales. So, but there's a good amount of those risks that are more service in nature. And then artisan contractors that you mentioned, contracting is still a big piece of our GL more driven accounts. In the past, we've written a lot of it. The market's definitely gotten more competitive in that space, so that's why we're making adjustments to be more competitive. But a big class, what we're always going to do is going to be contracting. And then, the other piece is your mercantile type of classes, whether it be a small store of, could be a food store, could be a distributor. We see a lot of things. We even see some more of the more troubled classes like convenience stores that we see a lot of movement on, but we can do convenience stores. Now we have guidelines. We want to make sure we're trying to pick some of the better ones out there, but it is a class that we have a comfort level with being able to underwrite.
Yeah, thank you. Agree. I mean, at the desk level, we see all sorts of crazy things. Pasta manufacturers, interesting service tech, and your more traditional contractors, HAB, restaurants, all of the above. So it keeps the day exciting the more variety there is. So we always love to see a variety on our desks.
That's right. That's why we're in the excess and surplus space. You get that variety, and that's why it's a space we're very comfortable with, and part of, like you said, some of the value we add to our customers, our partners, is we recognize this is E&S, and we're going to do our best to underwrite, do it well, and try to might not be able to do everything, but we do our best to look at things from a pricing coverage position and give options to our partners out there.
Well, I think that's all the time we've got for today. So for everyone listening, thanks so much for spending time with us. This was What's Brewing, and we'll see you next time.
Providing insurance answers together is what we do best. Thanks for tuning in to the latest episode of What's Brewing. Until next time.